on to our other big focus tonight. The global economy has been hit by a shock that markets fear the most: a sudden disruption in the world's energy supply. Oil prices have surged past $100 a barrel for the first time since 2022 as the war on Iran intensifies and threatens critical oil infrastructure and shipping routes in West Asia. Stock markets around the world, including in India, have seen a bloodbath. Energy prices are skyrocketing, and the world's richest countries, the G7 nations, are now preparing for an emergency meeting to respond to the spiraling crisis. At the center of the crisis lies one narrow waterway, the Strait of Hormuz. This narrow stretch of water between Iran and Oman is arguably the most important energy chokepoint on Earth. Roughly 20% of the world's oil supply passes through this single route every day, along with huge volumes of liquefied natural gas. When oil tankers move through the strait, they carry crude from major producers such as Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, and Iran itself. In normal times, this flow is the backbone of the global oil market. But war has changed everything. Iran has threatened shipping and tanker movements in the region, and military strikes have damaged energy facilities and disrupted exports across the Gulf. As a result, tanker traffic through the strait has dropped dramatically, and global markets are reacting instantly. Oil prices respond extremely quickly to geopolitical risk. Even before actual supply disappears, traders anticipate shortages and begin bidding up prices. In the current crisis, prices have surged above $100 per barrel, with some trading sessions pushing towards even $110 or higher. Several factors are driving the spike. One of them is shipping disruption. Iran's military threats have caused many tanker companies to avoid the region, while insurers are raising premiums or refusing coverage for ships entering the Gulf. Production cuts and damage to infrastructure are another major factor. Strikes have hit oil facilities across the region, and some Gulf states have temporarily reduced production due to safety concerns. Then there are logistical bottlenecks. In some cases, oil cannot be exported simply because storage tanks are full or shipping lanes are too dangerous. The result is a sudden global supply shock. Energy analysts warn that the crisis could become far worse if the war continues. Some estimates suggest that disruptions in the region could temporarily remove millions of barrels of oil per day from global supply. In extreme scenarios, disruptions linked to the conflict could create a supply deficit of up to 20 million barrels per day, an enormous shock to global markets. That would be one of the largest supply shocks in modern energy history. Therefore, the panic reaction in the markets. Oil prices have already risen dramatically since the beginning of the year, reflecting fears that the conflict could spread across the region. Whenever oil prices surge quickly, global stock markets tend to react negatively. That's because expensive oil acts like a tax on the entire world economy. Higher energy prices increase costs for transportation, manufacturing, electricity generation, and agriculture. As those costs rise, businesses see their profit margins shrink. Consumers too feel the pressure. Gas prices rise, heating bills increase, and goods transported by trucks and ships become more expensive. This reduces consumer spending, which slows economic growth. That's why the current oil shock has triggered sell-offs across global stock markets, particularly in Asia and the United States. Investors fear the war could push the global economy towards slower growth or even recession. The sudden crisis has forced governments to respond. Leaders of the G7, Canada, France, Germany, Italy, Japan, the United Kingdom, and the United States, are planning an emergency meeting to coordinate a response to the energy crisis. One of the key options under discussion is releasing oil from strategic petroleum reserves. These are massive emergency stockpiles stored by major economies precisely for moments like this. Some reports suggest the G7 nations could release hundreds of millions of barrels from these reserves to stabilize markets and lower prices. But even that may only be a temporary solution. Strategic reserves can cushion short-term disruptions, but they cannot replace a long-term loss of supply. Oil shocks always create both winners and losers. Countries that export oil often benefit from higher prices. For example, producers outside the conflict, such as Russia, the US, and Brazil, may see windfall profits as global prices rise. Russia, in particular, may benefit from the crisis as buyers seek alternative sources of crude oil. But the biggest losers are oil importing economies like India. Countries that depend heavily on imported energy, including many in Europe and Asia, face rising costs that can damage economic growth. Airlines, shipping companies, and heavy industry are especially vulnerable to sudden fuel price spikes. Perhaps the most serious economic consequence of the war is inflation. Oil is one of the most important inputs in the global economy. When energy prices rise sharply, they ripple through almost every sector. Food becomes more expensive, transportation costs rise, manufacturing prices increase. All of this can push inflation higher around the globe. That creates a nightmare scenario for central banks, which have spent years trying to control inflation after the COVID pandemic era price surge. If energy prices remain above $100 a barrel or rise even higher, central banks may face difficult decisions about interest rates and economic policy. Some analysts believe the current spike could just be the beginning. If the war intensifies, oil prices could surge far beyond today's levels. Certain forecasts suggest prices could approach $150 per barrel, especially if the Strait of Hormuz remains partially blocked. In extreme scenarios, Iran has warned that oil could even reach $200 per barrel if the conflict escalates dramatically. At those levels, the impact on the global economy would be severe. Past oil shocks, such as those in the 1970s or during the 2008 financial crisis, show how rapidly energy prices can destabilize economies and financial markets. The Iran war has triggered one of the most dangerous moments for the global energy system in years. If the conflict expands, the shock to energy markets could ripple across the global economy for months or even years. For now, the world is watching the war and the oil market very closely, because what happens in West Asia may determine not just the price of fuel, but the direction of the global economy itself. That's all the time we have on this edition of Global Pulse. Thanks so much for watching.